You were hoping for lower mortgage repayments this month, but you are not alone. After 2 rate cuts early this year, many homeowners were counting on RBA to deliver another 0.25% rate cut to give them some breathing room. But RBA just hit pause on holding the cash rate steady at 3.85%. Now, most of us were expecting that RBA is going to throw us another lifeline with 0.25% rate cut. That little move could have shaved around $95 a month off a $600,000 mortgage. That's the school fees, a few tanks of fuel, or a week's worth of groceries. So why the holdup? Especially when the inflation is under control at 2.9%. So what does this mean for the next few months? Are we looking for more rate cuts, or is it the start of another waiting game? In today's video, let's unpack what's really going on behind the scene and how this decision could affect your pocket. So hold on to your credit card spending for now, or at least until you've heard till the end of this video, because things may take turn for better or worse, and we are going to find out as part of this video. Hi, I'm Mohsin Reza, and on this channel, Australian Property Academy with Mohsin Reza, I break down real numbers, real strategies, real market updates to help everyday Australians navigate property and finance. I help build sustainable and scalable property portfolios without sacrificing lifestyle. For many families, this pause feels big. That 0.25% rate cut isn't just a number. It's a real difference in their monthly budgets. On a $600,000 mortgage, this would have cut repayments by around $95 a month or $1,140 a year. That's school fees, groceries, a month worth of fuel. The pause has left homeowners wondering if RBA is seeing something different or something that we don't see. Early this year in February and May, the RBA cut rates as inflation cooled and markets started to recover. With inflation now down to 2.9%, right in the RBA sweet spot, everyone expected another cut. And people were expecting cuts to come and keep coming through. While inflation has eased and the job market hasn't really cracked yet, unemployment is still low at 4.1%, meaning the economy is still running relatively hot. This hold wasn't unanimous. For the first time ever, RBA revealed its vote count. 6 members chose to hold while 3 voted for a cut. That transparency is unprecedented and shows just how divided they are about the next move. The RBA's dilemma is that they are juggling conflicting signals. Inflation is within target, but wage growth and low employment could mean future inflationary pressures. Confidence indicators are weak, job losses are creeping in, but productivity is still lagging. Cutting rates too fast could flood the market with cheap credit and push property prices higher again, undoing the very progress that they have made on affordability. But have they made any progress on affordability? RBA is not in the business of fixing poor government policies, but factors like low productivity, heavy regulations, and increased government spending at all mentality limits what RBA can actually do. This hold is partially a signal that monetary policy can't do all the heavy lifting. Understand that playing with interest rate is all RBA can do. If this gearbox or lever is broken and market confidence breaks away from what RBA is doing, then economies can go into hyperinflation or major recessions. What's next? That most economics are still predicting 2 more rate cuts this year. One in August and one in November. But global uncertainty is slowing things down. The US economy, the China slowdown, and the fluctuating oil prices are all on RBA's radar. 0.5% rate cuts would save homeowner with a $700,000 mortgage around $190 a month. That's $2,300 a year. An extra repayment per se. For many families, that's the difference between staying comfortable and dipping into their savings. Until then, the message is very clear and concise. Don't plan your budget around rate cuts until they have officially been delivered. But is that really the case? As an astute investor, you should never wait for the bottom or try to pick the top. Entering into the market now is what helps. It is almost guaranteeing the property growth. I've made my best money in times like these, and so have other astute property investors or investors like Warren Buffett. Invest fundamentally and enjoy emotionally. Do not swap places between these two emotions. I've got loads more content coming your way on smart property selections, financing strategies, and how to build property portfolios sustainably that truly delivers in today's market. Until next time, keep growing that wealth. Now, if you found this content helpful, don't forget to hit the like button or subscribe for no-nonsense property investment insights. Drop a comment below if you're ready to kick into your property journey, or if there is something holding you back, or if you have one of your stories to share in relation to RBA rate cuts. Thank you for listening to me today. Take care, stay safe, keep smiling, keep investing. This is Moss checking out. Adios.